hiking cycle actually 2000 October 21, and since then actually
Yes.
it is moving in
Yeah,
the same range.
yeah,
Right.
agreed.
So point is that, and second part I was talking is that many people tell that the Indian market, basically the Nifty is valued very highly, but I think this is not fully correct, because the last year was an unusual year with the high energy price, high commodity price, high logistic cost, war, unavailability of material, increased working capital requirement due to keeping high level of inventory. So those kind of things actually kept a little bit of stretched everybody's business. So if and when that clog, that cholesterol goes, so the earning will catch up. So I think the uh, crux of it is that the downside risk is much lower and upside is much higher. I don't think there is a very huge downside risk in this market. Otherwise, we would have sold and seriously sold and kept money in cash and advised investors accordingly. Rather, we told investors that withstand this volatility and stay invested, and this will actually this pain will give a good gain.
Perfect. Thank you so much. Chanak, yeah, you can go ahead.
Yeah, thanks, Ashank. Thank you, Avik sir, for giving opportunity to and your time to share your experiences. So, in fact, I have a follow up to what we were just discussing and what Shashank initiated. I have a query, Avik sir, around the micros per se. So, in markets from last 2 3 years, or in fact in general, there is a lot of phenomenon that you are observing, that there is a lot of sectoral churn that is happening. Maybe
Yeah.
in 2021 it was IT and pharma. In 2022 the financials have made a strong comeback. So with budget around and we are just beginning the new year 2020-23, what are some of the sectors that are on that can stand to benefit out of the either policies or some macroeconomics, and that are worth studying and tracking into as we step into next 12 months? If you can help, and maybe the reasons why they might stand to gain.
Yeah, I think that's a fair question. So I think presently, if you see the structure of the Indian economy, so what market has gone up by say 4.3% or something like that, 4% or something like that during the last year, or maybe 0% if you talk today against 1 year back. Vis-a-vis, if you see this Indian last NSSO data which has come out, the Indian economy has grown by 7% and nominal rate it has grown by 15.4%. So 15.4% of nominal growth has happened in Indian GDP against that market has grown by 4%. So it can say either of the two things, right? Or the market has not value market has already valued this particular growth, or market will value this growth in future, because this particular thing is there, that market economy has grown by 15.4% nominal rate, and the budget expected economy to grow at a nominal rate of 11.1% with GDP deflator of 3.8% and real GDP growth of 7%, 7.5%. Against that, we are growing at 7% with a nominal growth of 15.4%. That means the GDP deflator will be much higher. So, why I am saying all these technical things is that then the budget will come with a kind of a optically good standing for the finance minister, because our tax revenues are high, our GSTs are high, courtesy high inflation, and but that will keep the budget balance in check. So that will help in actually making an investments into infrastructures more, because last year also the infrastructure spending by government of India actually has kept whatever growth rate we have got this year is due to that, because the consumption economy.
Am I the one who is missing out?
I think we lost Aveek Mitra's voice. So, Shashank, can you hear him?
No, I can't. I think he dropped.
Oh.
Maybe due to some technical reason.
Can you guys see him? I cannot see him in the space. I sent him a request, but I cannot see.
Prince, I guess he's not there.
This is really bad, yaar. Today glitches are happening so frequent. We started it thrice. What shall we do, Shashank?
Uh, Difficult to say. Try sending him the same link before, like like the one that you sent for this space, and then ask him to join again.
So by the time he joins, Kaushik, can you take off from here and explain our attendees the current landscape we have? S- Can you speak, sir, now?
Yeah, so I think that in a nutshell, I think budget is a thing which will be a short-lived kind of an euphoria which always happens every year. So depends on what way the budget will spend the government's money, that will have an immediate impact. But beyond that, there won't be much impact for budget and all. And the budget will become unimportant over gradually over a period of time, because ultimately, what is government expenditure of the entire thing? Like government has got 30-40 lakhs of expenditure of a $3 trillion economy. So out of $3 trillion, government invests what? Government is almost 200-300 dollars, 400-500 billion dollars kind of economy at the most. 14-15% of Indian GDP is actually covered by the budget.
So, Avik, sir, like if you talk in the terms of election year, so do you find any segregation as far as the budget is concerned?
Segregation means?
As in, like we the elections, general elections are approaching after an year, so maybe a populist budget. So
No,
that will
no, I
also be
think I
some.
have given a lot of numbers, right? So I don't know if you have heard those numbers, because Indian, was those audible to you guys?
So, Avik sir, we lost you when you were just talking and comparing a couple of years capex play on capex outlay of Indian government after budget on infrastructure, and that's where we lost you, I guess.
I really don't know actually, because what I was trying to tell at that point of time, did you hear this particular thing that I said that the market has grown 4.3%, but our nominal GDP has grown by 15% as per latest NSSO data? That part was
Yes,
heard.
yes, that was heard,
Yeah,
Avik sir.
so if that was heard, then what I meant to say is that, so I don't know whether this 15% growth of Indian nominal GDP has been priced in the market, or it will be priced in the market. It is difficult to hazard a guess, but I think uh, that keeps a block on the downside. So I don't think the downside risk is much higher. Uh, that upside is.
Hi, Aveksat. This is Kaushik. Happy New Year. I just have a question regarding our market cap to GDP ratios are being in the north of 130%. So is this it doesn't look like entire capex coming into play, or like the entire company whoever has announced the capex, mega capex, and taking the benefit of PLI, their PEs and the brand, for example, in the consumer durables, their branded players are actually valued at a higher multiples of PE, and the white good manufacturer who's just a contract manufacturer, they're also valued their PEs at a very high. So how do you look at this entire nature, sir? Means was I audible?
Kaushik, you are audible, but I guess there is some connection issue on Avik's part, maybe.
Oh, got it, got it.
Yes, sir.
Yes, Avik sir.
Yeah, I'm sorry. I don't know what is happening. So it never happens generally like this. So, sorry for my side. So uh, what I was telling is that, so government has got a good amount of cushion in their hand, because the tax revenue is high, and GST collection is high, and the budget balance will be whatever has been projected last year. So that part is pretty clear from the uh, numbers which has been published by NSSO recently, a few days back. So from that, I think two things can happen, right? But if the budget can be populist, because as I was mentioning, that 80 crore people is needing ration for survival. So that doesn't tell a very pretty picture about Indian economy. Though the market participants and the 15%, 20% people who are the investors and who has money in this country has got enough money to invest and spend. So, but for an election year, the rest 80 has to be looked into, and I think they're rightly so. There is nothing wrong in this. And for that, and we know that the consumption economy has not done well in the last year. If you listen to the con calls of all these companies, starting from Hindustan Unilever to Marico to Dabur to everybody, they will say that the consumption economy is doing poorly. So whatever part of the consumption economy was doing well was that which had been consumed by the upper 20%, or maybe the kind of wannabe aspirants of the Indian society, like say quick service restaurants and things like that, or say branded apparels or branded shoes and things like that. So I think if government spends more money on populist budget, then it is fine. There is nothing populist basically, because you need to look into everybody in this country if you are running a government. And being elected, they have a right and the choice to do whatever they like, right, for winning an election. So, and second is this: if the investment in infrastructure and all are remained in focus, then I think the rest of this companies which are into infrastructure or related area will do well. So, but as I said, I think again in the beginning, this budget is a 4-5 day event in India, and this is a jamboree in India, not anywhere else.
Right, sir. So Kaushik, you can unmute and ask your question now.
Hi, Aveksat. This is Kaushik. Happy New Year.
Happy New Year.
Sir, I just wanted to understand, sir, in Indian data, like market cap to GDP is being in the north of 120 to 130 percentage now, and with capex, like a lot of companies have come up with their capex, and they have just diluted their equity and reduced their debt to equity ratios and made their balance sheet very stronger. But what I find a concern, sir, for example, if I take consumer durables as a sector, the branded players like Voltas or Amber, the branded players like Voltas, Blue Star, or Whirlpool, they have their piece in the north of above 50%, 50s. And when it comes to the just a small player like who is a contract manufacturer who is just manufacturing with an PAT margins of 3% or 2%, have actually have a piece of again 50s. So what does this mean, sir? Like I just wanted to understand, is this not look like an overvalued zones, or like just I know this next decade is actually for India, but doesn't it look like it has been priced in, and that's the reason our entire currently markets haven't performed as per the economy has performed. Economy has performed around 14%, but our markets have just performed around 4%.
The economy has not performed 14%. Basically, inflation has performed the 14%. So, economy has only grown by 6-7%. So, anyway, having said that, so I think your questions are very valid. So, there are pockets of this market which is very, very, very costly. Now, that actually assumes a growth rate for coming 10 years at a much higher rate than whatever growth rate was previously there. So my suggestion there is that if anything looks so absurdly costly, you don't invest there. But if you can project, say, suppose something is selling at a 40%, 40p or 50p, and the company, if you can think that can grow for say 40% for next 3 years, then there is no harm in investing in 50p. It all depends on how that company is levered. If it is levered, then 50p is a no-go zone. Just avoid uh, like a plague. And if it is unlevered, it is a clean, it is a balance sheet is clean, management is good, and company has got 30-40% kind of growth rate possible in as per your analysis, then invest. Because I think if you 3 years down the line it becomes 20p, so even if there is a PE derating of this stock, the earning will take care of this. And there are pockets, like say you say contract manufacturing. So as we read, the contract manufacturing sector is going to grow at a rate of say 30-40%, and it is coming from a very, very low base. The base is 1%. It is not that the Indian base of contract manufacturing of electronics is very high. On a global scale, I think we don't even manufacture 1% or 2% of the total electronic manufacturing. So that kind of call you need to take on Indian market. Indian market is costly, will always remain costly for two reasons. One is that domestic investors have got only opportunity to invest in Indian stocks mostly, number one. And number two is that contrary to many people's popular belief, I think the Indian market's corporate governance standard on average is better than even companies listed in Singapore and elsewhere. So and our disclosure standards are pretty good, so you can make out. So that kind of premium, a growth premium plus corporate governance standard premium, and will remain, and also the limited ability of the investors to invest elsewhere. So that kind of three things will keep Indian valuation high, and you have to play through this. And there, I think you need to look into the relative valuation based on how it was valued few years back vis-a-vis how it is valued now, vis-a-vis what is the growth rate, vis-a-vis what is the type of balance sheet structure they are having compared to 3-4 years back. So if you triangulate all three things together and feel that it is useful to invest. Otherwise, stay away. There are thousands of companies and you need only 20 companies to invest in.
Nicely answered, sir, and thanks for that. So I
Yeah.
have a follow-up over here. Sir, it's really great. Their balance sheets are looking very fantastic, but their balance sheet is actually looking fantastic just because they have diluted their equities in the recent past. So like any company that we talk on consumer durables or cap goods, they have literally diluted their equity and they have raised their capital at an higher valuations. And not only that, nowadays, like from past 1 year, I'm seeing this Shark Tank coming into play. Like every person, and you also know that I had an plan to start my own business. Something like everyone has this crazy thoughts about starting their own business and valuing their entire company at a higher pace. So how this will pan out, sir? Like how with your experience, how can we get in negotiable with those both the points?
Now, frankly, I didn't completely comprehend your question. If your question is that a company has, instead of resorting to debt, has increased their equity, and
Yes,
that
sir.
has actually, so that is one part of your question, right?
Yes, sir. Yes, sir. You're
Yeah.
right.
And what was the other part of the question?
And other part of the question was like every time that they're going and if they are even raising equity, that's good.
Hmm.
But they are raising their equity at such a higher base that's
Hmm.
actually literally it's making that an unavoidable market. So it's do you think like in this if I even look the markets for next 5 years, will it like look like lucrative for this kind of growth, whatever we are expecting? Still, this kind of dilutions and this kind of returns would actually matter.
Oh,
It's
I
very
think
simple.
I think that I don't know exactly the valuation of Blue Star right at this point of time, so I cannot comment on a Blue Star or a
It's not
Voltas.
blue
So
star. So it's about the
no,
consumer durables and cap goods,
no,
every sector
I'm
that
I'm
I'm talking
coming to
about.
that. I'm just taking an example. Okay, so what I'm trying to say is that I don't know about the particular things, but I know about some electronic manufacturing companies, the contract manufacturing companies. We are invested in one of them, and we feel that their growth rate is fine. Their growth rate can justify the kind of valuation possibly over next 3-4 years period. And people actually invest for growth in India. So there you need to decide that whether you play for that, because at the same time in Indian market there are pockets of good, well valued, reasonably valued companies that are available in pharma space, in IT space, in even infrastructure space. There are things available which are reasonably priced with good balance sheet. You can then invest there, and whenever you find that there the valuation is coming to your comfort zone. Ultimately everybody's comfort zone and understanding of the market and where to invest is different, and that makes the market great, right? So if everybody had a same opinion, then there would have been no market, there would be no two-way court. So if you think that, I feel that this area of the market is extremely highly valued, and I generally avoid this kind of things when there is an euphoria and everybody is getting into that. So I am not invested into this except one stock. And having said that, you also can follow the similar approach, that look elsewhere and there are opportunities available.
Got it, sir. Thanks for that.
Saurabh, you can unmute and go next.
Hello, Prince and Avikji. I have a question regarding IT sector. It's
Yes.
already 25% down. So it's good to buy IT sector ETF.
I really don't want to discuss on particular stock, but I think that you should be stock specific in this area also. But remember that, as I told in the beginning itself, that there are two type of businesses primarily. One is growth business and one is free cash flow generating business. Depending on your risk profile and your investment in return expectation, you should make investments and how you make allocations. If you are actually investing for the growth part of the IT business has plateaued out. I do not think that Indian IT, specifically the traditional IT business, can grow at a rate of more than 10-11% because the base is so high. And since our companies have not really evolved themselves beyond this big to very big to very big to almost monumental kind of a uh, uh, outsourcing agencies for other clients, it is tough for us to really grow at a higher rate or really increase our profitability. So keeping these two in mind, you should make an investment now, or maybe if you wait for one more quarter, it may be fine. Or you can put half money now and half money quarter down the line. That is also good. But the valuations downside risk is less, and going lesser and lesser. I do not think that TCS result has come out as a very big negative or something like that. They have done reasonably well. So these companies are very reasonably well managed to withstand this kind of crisis and continue growing at a reasonable rate, giving you a reasonable rate of return. And if the rupee depreciates, you will get a little higher return. If the rupee appreciates, you will get a little lower return. But rupee appreciation is a high possibility. I don't think rupee is going to depreciate very much from here on. So keeping that in mind, you need to take your call.
Uh, uh, yeah, thank you, Vikji. I have one another doubt, regarding broker. Is Geojit Financial Service is a good broker? Like, you already been market from many
I have
years.
no idea. No. I don't want to comment on something which I never tried myself. I don't want to comment positive or negative on anything which I don't know.
Okay, thank you, Vikji.
Thank you, Saurabh. So, AJ, you can unmute and go next.
Uh, Hi guys. No, I'm actually really enjoying listening to the expert views. If I'll have a question, I'll definitely ask. I hope that's okay.
Thank you. So, Nihar, you can go next.
Uh, Happy New Year, sir. And Avik sir, I had a simple query here. Like you said, your allocation on each script is around 4 to 6%. So, in that manner, if some investor comes up and tries to build a portfolio, it would probably take him around 6 to 8 months journey to do the spot, to do the stock picking and allocate himself 100%. Or how do you go about building a portfolio? Thank you.
No. That is I'm talking. First of all, Happy New Year to you too, Niha. And I am talking about the portfolio building up of the portfolio advisory. So I don't. I will build it up in one go. I didn't understand your question. Why? How can it will take years to make it? Or are you talking about equity advisory member of Aveksat Equity who wants to build up his entire portfolio based on the advices given? So I
Correct,
don't know
correct,
what.
correct. The second point, yes,
Okay,
on the
if that
equity
be so,
advisory
then then
services.
then we are not taking responsibility of that person's portfolio build up, right? We generally give a guideline that this part of this is an investable idea and this much is to be invested. So we are not taking the responsibility of 100% portfolio. We actually give a kind of a recommendation based on a premise that a person has 10-15 lakhs to invest in total. Okay, so that is not a portfolio built up is the objective. The objective is to give good stock ideas. We feel that having a uh, good growth opportunity ahead, or there is an opportunistic bet of making 20-30% in 3 to 10 months, 6 months time. So now, if you have to build up at any point of time, I don't know, Aveksat Equity portfolio advisory, equity advisory, maybe having about 15-20 stocks at any point of time for clients. So that way he can build at least 70-80% of his portfolio. But when I am talking about this particular thing, entire premise was on the portfolio advisory service.
Okay, thank you.
Thank you.
So before coming to next speaker, sir, like when it comes to passive investing or say mutual fund investing, so what's your view on that? Can good money be made through mutual fund investing as well?
So here I think from the day one, I have in my website on things you must know. I have made a very straight observation about mutual fund that we are against investing in mutual funds. That is because of too much of over diversification. They have 70-80 stocks in the portfolio. Almost 50% of the weightage is on the top 5-6 companies of, say, Reliance, HDFC, ICICI, Axis, TCS, Infosys. So, and you can make some slice and dice here and there, and it will be ultimately 50% to 60% portfolio of all mutual funds look alike. Okay, they play around with the rest 30-40%, and they have to keep certain portion of the fund liquid also. And so if you keep everything in mind, so it is good for smaller investors for building up the initial corpus. He doesn't have time, doesn't believe any advisory, doesn't believe any, are not ready for advisory or PMS or AIF or things like that, and he doesn't trust this kind of things, or doesn't want to pay upfront fees rather than want to pay fees which are deducted from his money. Ultimately he pays the same thing, he pays 2% here or 2% there. So that money has to be no mutual fund charges less than 1.5%. So point is that keeping all these things in mind, if the investor has matured enough, he should gradually come from investing in mutual fund to investing into either PMS or portfolio advisory or things like that. And I run portfolio advisory simply because of the fact that I want investors to have control over their own money, rather than I can easily start a PMS service, but I will not do it, and I will keep it in an advisory mode, because I think that ultimately investors should keep control of their own money, and if they find that they want to sell off, they can sell off. So this is a second layer of security for an investor to ask to, where that is what we feel, and that is how we have built up. And there is no exit note, nothing. We charge a fixed fee. So uh, I think that's it. So mutual fund, yes, but at the same time, the person who is a small investor having say 10-15,000 rupees of regular income, he want to invest. That kind of investors, absolutely, it is good for them to invest in mutual fund, because they are not yet ready or prepared for coming for an equity advisory service. That also is written in our portal from the day we started our service, that unless you are having say 10-15 lakhs to invest, our service is not right, equity advisory is not right, and unless you have 50 lakhs to invest, the portfolio advisory is not right kind of scheme for you. So to answer your question, for generally, I don't like mutual fund investment. For SIP kind of investors who invest a 5,000, 10,000, 15,000 per year, yes, this is absolutely right things to do, and that's it. And I've told the limitations of the mutual fund, as all are almost alike. Whatever be the name, all are same.
Right, sir. So next we have Nanda Kumaran. So you can unmute and ask your question.
Hi, sir. Good evening.
Good evening.
Sir, my question is, what is your view on PSU banks as a sector currently?
No, I have no view actually. So I think that this whosoever had this, I have got certain portfolios of late where people had this kind of large PSU stocks holding for 10 years. I told them that you sell off and just get out of it. So they have sold it, and we have built up a portfolio from ground up. So I don't have any kind of because ultimately these have reached the valuation level on the market cap basis. They have reached the valuation level which was there actually 10 years back, right? It may look optically cheap simply because of the fact that they have got a dilution, huge amount of dilution happened in between, right? So having said that, there is no change in culture. There is fundamentally nothing has changed, and a business of bank can only do well if they make the next level of dilution at a price which higher than the book value. But sometime I think the latest dilutions were happened when government actually increased the put money. I think I don't really remember, but I think that it is at a price which is lower than one time book value, but I may be wrong. Okay, so I'm just talking from my memory. I may be wrong. Others in this call can correct me if I'm wrong. So I really don't follow it very well. So honestly speaking, and I suggest that if you got an opportunity, you get out of it.
Right.
Thank you, sir. Thank you.
So next is Suresh. Suresh, you can unmute and ask your question. Suresh, we can.
Hello.
Yeah, Suresh, go ahead. Suresh, we cannot hear you. Are you there? Okay, Ravi.
I think
Yeah,
you move forward. Yeah.
Suresh, go ahead. I think some issue. So Ravi, over to you.
Hey, thanks, Prince. Hi, good evening, Avik. I'm not sure if you remember, we interacted in 2017 when I was part of IR advisory. I just have few small question if you want to throw lights. Say, given our interest rates are rising, what kind of percentage of cash you are advising to hold in the portfolio, and what percentage of incremental, what kind of incremental investment we are looking at, what kind of cash we are uh, retaining in the portfolio, and are we looking to have more on the debt side instrument because they have become very lucrative. If we look at even the GSEC is about 7.3, even some of the InvIT is about 9%. So, what kind of allocation strategy we are
Yeah.
adopting at this juncture?
Now, InvIT, I don't really follow much. So I have some personal investment into the InvIT, but I don't have any advice on InvIT kind of investments. And about the interest rate and increasing interest rate always works as a friction, as a gravity against the stock P, right? The P valuation part, on the valuation part, the interest rate acts as a gravity. So, but beyond that, the relationship between higher interest rate and stock market performance, there is no correlation, because if you see this 2003 to 8 period, our interest rate was probably much higher. Even then, the market has grown up. So I don't have a specific cash strategy as of now, because as I told in the beginning, that I advised investors to remain invested and withstand the volatility than actually stay in cash, because I don't find any reason to stay in cash just because there is an increase in interest rate. Okay. So, but at the same time, yes, there is a possibility that in the balanced fund, which is called the balanced fund in the normal parlance, the money will shift from a part of the money will shift from the uh, equity to fixed income. So that can create certain kind of a liquidity pressure on the equity market. But once the interest rate settles at say 7-8% rate, then sorry, on a 6-7% rate, then again I think the stock market will start valuing this, discounting that. So I don't have a cash call right now.
Sure, sure. Thanks. And you were absolutely right. There was dilution that happened in the PSU bank in 2017 and 18. I guess about 15,000 crore each in both of the financial years. That kind of dilution was happening from the government side.
Yeah, I think that value almost reached the same value. See, the price to book basis, they have reached the same kind of valuation. At the same time, they have lost market share in between. Lost market share in between.
Right. So Avik sir, we have two more speakers. So we take last two questions from them and then we wrap it for the
Yeah,
day.
yeah,
So,
it is.
so,
Yeah,
so
it is.
Suresh, we give you another chance. You can unmute and ask your question. Suresh, we still cannot hear you.
Can we move to the next?
Yeah, Gaurav, you can quickly unmute and ask.
Uh, hi, Prince. Thanks for the opportunity and thanks for hosting this space. Thank you, Avik sir, for sharing your insights. Avik sir, there is more around investment approach. Uh, so you talked about investing in small cap and mid cap for a duration of 2 or 3 years. Then we talked about sector rotation. So when as a part of your portfolio strategy, do you try to allocate stocks to various themes that these four stocks are for I am holding for close to 3 years. These are part of my sector rotation strategy. These are part of my techno fund or something like that. So is that an approach you take, and how do you then allocate it in various strategies? Like just an approach, I think if you can share that. Hello.
I think Avish sir also got. Yeah, Gaurav.
Uh,
Avik sir, did you hear the question from Gaurav, or shall he repeat?
yeah, if you repeat, it is fine. But I think I got the gist of it. That how you differentiate between different kind of styles. Is that the question?
Yeah, one is that, and second is how do you try to allocate your portfolio basis these styles? Do you have a percentage in mind through these strategies, and how do you try to keep a mix of them? Yeah, thank you.
Yeah, that remains a kind of a dynamic process. So if I say that I have got a etched in stone process that I will exactly do this for a particular thing, that is not like that. But I have a etched in stone process about the risk profile of that investor. If I find that the risk profile is suits, then I remain a dynamic kind of a person. And I also don't have a kind of an sector particular allocation that I will allocate only this much into this sector and don't invest more than that into the sector. I don't follow that. That is more followed by the persons who follow a model portfolio approach, because I don't follow model portfolio approach. So we create a customized portfolio for every individual based on his risk profile and expectation within the overall universe, and again following the same parameters which we have mentioned. And on the technical part of it, yes, we invest into opportunistic bets for maybe 10 to 15% of the portfolio. We remain for go for an opportunistic bet which can generate that extra alpha which we are looking for. Apart from that, we always look for a kind of a view of 2 3 years. But at the same time, if we find that the valuation which we suppose we have a 3 years view, and 3 years view the valuation, we thought that 100 rupees will become 200 rupees in 3 years. But sometimes stock market gives 200 rupees in 6 months down the line. Then we try to see that whether this there is a further upside to write or get out. So if we find there is a signal of getting out, then we get out of the stock within 6 months itself. We don't wait for 3 months 3 years because we initially thought we should wait for 3 years. At the same time, if we find that something which is not working for 2 years, then we hold for another year to give it time, if we are confident. Or if we just sell out and think that I have found a better opportunity and it is showing a kind of better growth momentum, then I just sell off that and invest in something else. So that kind of dynamic play is always there, and that is how we have generated the return. Else we could not have generated the return which we have generated, and remaining a kind of a positively skewed vis-a-vis the volatility.
Good, sir. Thank you. Thank you, sir.
So we are done with the questions, Avik sir. So one last question on good investing literature, which you would like to suggest to our attendees today. Any good
I
books
think
which you
I think
find
I
that
think a lot of good books are there, and a lot of good books. I have nothing else to say about the books. All the books are known to everybody, but to me, I think One Up on Wall Street on Peter Lynch is a very fundamental book. Apart from Warren Buffett letters and Howard Marks memos. And I think that more important than that is that you read as much as annual report possible, analyst con call possible of not only Indian companies, of the global companies, of the competitors, or similar kind of industries, which how these industries have evolved elsewhere in the world. And that enough material is available in the internet for free. If somebody is really serious, take one industry, go deep into it, see that how that industry has evolved over a period of time. Suppose somebody is investing into new age area. If the new age area is not so new in other part of this world, then see that how that particular business in that particular geography and work. And also in I think study the failures. I think most of the people many a time don't look into failure. People look into multi-bagger returns and then tell this and that, that I have invested here, it has become 5x, 10x. You don't know how much that person have allocated at that point of time. Secondly is that you don't know how many have failed in the process of generating one multi-bagger. And sometimes you take a failure and start take a failure pattern. If you find a pattern in the failure of the companies and what are the parameters. So those are understood basically by getting thinking and reading about the business rather than reading books, because ultimately books will give you a broad framework to think, but ultimately to give that framework an activity, that particular a framework has to be activated in your mind. How you can activate that framework? You can activate that framework only through going through live examples and then live analysis of things, that what has worked, what has not worked, for which companies worked, for which companies failed. So these kind of playing around with your mind, it is a mental exercise and mental gymnastics. If you do, I think you can be a good investors, rather than just reading books or listening to other people.
Fair enough. That's a good advice, I must say. So, Avik sir, like you talked about reading annual reports and all. So, is there any good way to read annual reports? Because at times reading 250 pages or maybe more than that is a tedious activity. So as to get the gist of the annual report, is there any way we can
Oh, absolutely, absolutely. This is a very simple to answer, because they are why you read the full annual report, because ultimately you first of all you would read annual report for companies which you first decide, right, through some kind of a idea that I will only read these annual reports, say the successful companies, or only the failed companies annual reports I will read. Then annual report you don't need to read everything. You first read only the management commentary, operational performance reviews, and the basic accounts. Then if you decide that if you are interested in this company for an investment purpose, then you get into deep dive, then into code into each line item, basically on the accounts part of it. If you have a problem with the if you have a question about the corporate governance part of it, suppose you don't have much of a question on the corporate governance part and things like that, then you can also give a brief study of that and then move ahead. That is number one. Number two is that you can filter only the what should I call this management commentary, or what is the management discussion and analysis. Sorry, I was just searching for the right word. Only the management discussion and analysis part and the operational review of the directors, and move ahead and go to the next company. So that way you can cover many companies in one go and then decide that where to give more time. Otherwise, if you start reading from page 1 to page 250 for each balance sheet, then it will be not only tedious exercise, it will be useless exercise.
All right, that's a great advice to follow. So thank you so much, Avik sir, for sharing your insights over
Not inside, I
acquired
just
over.
discussed. I have no extra insights. I think you guys also all have insights. So we all are a learner in this school of investing.
Yeah, right.
I have just spent a little more years. That does not mean that I have become more knowledgeable or anything else. Yeah, I can share more perspectives. I can share more stories. That's all.
Yeah, great, sir. Would appreciate to have you again sometime down the line. Thank you so
Sure,
much
sure,
for
sure.
your time, and it was a
Thank you, everybody. Thank you,
okay.
everybody, for that. Thanks.
So, guys, the session, although we had a few glitches, the session is recorded, and I'll be placing it over my handle. So, in case you're not aware, there is a YouTube channel by the name of Accidental Investor Prince. So, if you haven't come across it, you can have a look. And there are all 65 plus podcast already uploaded with the great investors. And whatever podcast we do, I record it over there, because on Twitter Spaces the recording is removed after a period of say 30 days, so as to keep it for long time, so that we can revisit at any point in time. So that channel has been created. So if you feel that you find some value in that, you can subscribe and listen to that. So with this, I take your leave and thank you for your time. Keep joining again. Thank you. Good night.